The views and opinions of this program are those of the host, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading.
For over 95 years, we've set the bar. Power, we restored it. Protection, we reinvented it. Record yields, we redefined it. If there's one thing we know at FS, it's that just because something hasn't been done, doesn't mean it can't be done. We're never satisfied unless we take your farming operation to the next level. Run your equipment at peak efficiency and bust the bins this season. Visit fssystem.com.
Well, on Wednesday, we officially flipped the calendar over to the month of November, saw a somewhat quiet market trade for grains and livestock. Meantime, we were watching to see what the Federal Reserve had to say about interest rates as they wrapped up their two-day meeting. We're going to talk about all that and more here today as we are joined on Market Talk by our good friend Mike Zuzolo with Global Commodity Analytics. And Mike, it is great to have you back on the program here today, and hope you are doing well.
Doing great now that the Federal Reserve has made their announcement, Jesse. It's always kind of like a WASDE report day for me because of the way the markets and the grains and livestock tend to be, pretty reactionary, kind of similar to what they do after big USDA numbers come out.
Yeah, I couldn't agree more there. Let's talk about it. The Fed left interest rates unchanged. Still, the caveat, 22-year highs, but we left rates unchanged. Now, I know a lot of folks expected that, but we were watching closely to see what the Fed had to say in their commentary afterwards. What did you gather from what Fed Chair Jerome Powell had to say?
Yeah, as we hit the record button on today's Market Talk, it seemed as though he was reiterating their desire to go ahead and keep the inflation rate down and get it down still to 2%. But as you say, they hit the pause button with the idea that we do have financial markets and bond markets and credit markets to watch. And they did include that in their policy statement. He hasn't really addressed it yet as we go into the press conference, but I do think it is very welcome, especially given that we have that third leg of the stool, that macroeconomic stool of the currency and energy prices now. So we have the bonds and the currency, bonds and the energy prices with the Middle East war. So I think today's update from the Federal Reserve is going to make his press conference more important, because as I got into more of his in the Fed's statement, it seemed to me you couldn't draw a line between them being in a long pause, i.e. they're done for now, or whether they're just going to pause this month but come back around in December and raise rates again.
Well, and I know that's a big thing that we need to watch closely is, are they going to raise rates again? Walk me through this chart on our video feed, looking at two-year yields and just some of the things you see here, and put that in terms of what we're getting from the Fed right now.
Yeah, this chart really shows the impact of what the Federal Reserve had to contend with in their update. And so this chart, I think, has more validity to it versus 24 hours ago before the Federal Reserve put their statement out, because they did talk about credit conditions and financial markets. Credit conditions are highly restricted when a 2-year and a 5-year bond yield, that short-dated money, really starts to go up. Some of the people I know that I don't work with, but I know and I'm in meetings with periodically that work in lending, private credit markets. They're upwards of 10% in terms of lending to businesses for debt loads, and in part because of this 2-year and 5-year treasury yield. So we're bouncing around 5% on the 2-year money right now. We're up there at 2006, 2007 levels. We go above those levels, Jesse, and I think we're in recession. I think it's just going to drill us into recession. We take that combined with high crude oil prices, any higher than we've already been, I think it just doubles down the recession. I think the Fed gets it. And so I do think the Fed is working in real time, which alleviates my stress about the commodity markets more. The trend line, that purple magenta colored trend line in this interest rate yield chart drawn off those 2021 lows, That's a big thing to me, because if we take that out, knowing how much we trade every day and pretty efficient how this market is, we take that out and we go below, say, 4.9% on that 2-year money, that designates or suggests to me that the market is assuming the Fed is done. It's not just a pause. So I'm going to use that line as a way to kind of give me an answer of what the markets are thinking based upon what you just asked.
Well, you mentioned the legs of the stool there, and on the flip side of all this with the Fed, you mentioned energy prices. We have the Middle East war going on, and I know that continues to be a concern for a lot of folks here in terms of not only the humanitarian side of this whole situation, but again, the impact on energy prices and more here around the world.
Yeah, the slide you're seeing right now is part of my client-only webinar. I've done part one talking about the macroeconomics, talking about what we just talked about with the Federal Reserve and the bond markets. Now I'm looking at energies, and once I get done with the energy in the Middle East, I'll throw out some expectations for agriculture prices in the first quarter of 2024 for my clients. I am of the opinion that the situation in the Middle East is going to get worse before it gets better. It's going to be similar to Russia, Ukraine, because of the fact that China, Iran, and Russia are all essentially in a land grab at this point. They see the timing as now for them to be able to expand their empires back to where they were 300-400 years ago. And I think that's the similarity they have. And I think that's why, as the Foreign Affairs article headline and picture shows on this slide, Iran has new patrons, China and Russia. And so these three, I think, are going to cause more havoc in the world in the short term. If I'm right about that, and if you look at the disruptions in oil supply driven by past conflicts that the World Bank put out not too long ago, typically these disruptions in oil supply are big enough, even though we are less reliant upon Middle East oil as we were back in the 70s and early 80s, we're still nonetheless reliant, and the world is reliant upon them probably more than ever when it comes right down to it in the last 5 or 6 years. And so I'm going to say to clients, make the case in 35 slides, essentially say, hey, I'm looking at a conflict with odds of 70% of getting expanded in terms of a regional war in the next 45 days. After that, I think it's a lot like what happened with Russia and Ukraine. After that, the markets price it in. And quite frankly, the speed at which Israel is moving right now, it really doesn't matter what Iran does in 45 days as far as conventional warfare, because in 45 days, I think Israel will be cleaning up at that point and winding down their offensive. But the bottom line here for me is this is a religious, ideological, geographical battle that the West, the crude oil market right now, has not factored in hardly at all, because we keep pulling premium out as fast as we put it in.
That's a great point you made, and you led me to my next question. What it was going to be is we've been pulling a lot of premium out of this crude oil market, Mike. I mean, flirting with $81 a barrel on Wednesday. I know we got some updated oil numbers, ethanol numbers out Wednesday as well. We actually increased a little bit, excluding the Strategic Petroleum Reserve for U.S. inventories. But to your point there, if we see a wider escalation, crude oil ticks its way back up. Crude, we talked about it being kind of a canary in the coal mine. It could move grain prices higher potentially, but also I feel like this might be a good time to think about some fall energy needs if you haven't done so for the next couple of months ahead on the farm here, Mike.
Yeah, I agree. I think you need to go all the way into the springtime at this point, Jesse, as the prices go down. And I'm less worried about natural gas, but I think the reflexive nature of these markets when it comes to the energies, that natural gas will probably also get a pull up. But I think it's more important to work on your diesel, your heating oil, your anhydrous for the springtime as well, is something I think you should concentrate on. You brought up the energy data, and rightfully so. We are making brand new gains, even though our rig counts have not gone up. We're pumping up 13.2 million barrels a day of oil right now in the United States, a new daily record made in the month of August. And it looks like we're going to do every bit of that in September. And so I do weigh the increase in the domestic supply against what we see in the Middle East potential when I look at this webinar. So I try to look at it from about all the angles of the prism if I can.
We're having a conversation here today with Mike Zuzolo from Global Commodity Analytics. Mike, want to talk grain markets a little bit more in depth here with you. Kind of quiet, mixed action in the grains midweek. Obviously, watching the Fed news. We're going to be watching the energy market, how that could impact things. Soybeans, meal. We've seen this kind of meal rally that's really been our driver here. Bean oil backed off a bit on Wednesday with crude falling down a little bit. Corn's been quiet. So, I mean, it just feels like even with the new month, there's a lack of fresh news per se in the grains. I wonder your take in this grain trade overall right now.
Yeah, I agree with you. I think a couple things there, Jesse. First is the Federal Reserve. I do think that whenever the Fed comes out, it's kind of like the brand new trading week starts. And so I'll look at Wednesday night. Tonight's trade as the first of the week, essentially. We've had a lot of news in the wheat and in the grain markets. I mean, China is buying a lot of Australian wheat. The market knows that. They're probably heading towards record imports of wheat at this point because of their poor crop situation. Russia's Sovcon cut their crop down and their exports down almost 500,000 metric tons in wheat. So I think we've finally gotten that supply production top and cap in the Russian production. Ukraine came in and said year to date for the marketing year, their grain exports are down 31% year to date. Russia also came in on Wednesday and banned durum exports for 6 months. And so I think you've got a lot going on in there. And plus you add to that, the USDA ag attaché talked about Argentina's grain update, and they took down the wheat production. They took down corn production, and they actually took the production and the exports down corn exports down 3 million metric tons versus USDA's official number currently. A lot of news out there just didn't translate into the trade. So I'm wondering if we weren't waiting for the Federal Reserve. We'll see what Thursday and Friday bring us, and have and attach maybe the post-Fed report with these fundamentals and the weekly export sales and see if that doesn't change things. Corn's really dangerously close to losing some of its key support as it made a new 6-7 week low today.
I'm glad you brought up a few of those headlines that I missed in wheat. I apologize. Normally, I'm a little more on top of those things. But, with the case of the wheat markets, we talked about this quite a bit, Mike. It feels like that corn, if corn's going to have any chance to rally outside of some sort of bullish headline, wheat's going to have to be the one that kind of pulls corn along like the little brother and says, hey, come on with me here. That's what it kind of seems like to me here as I look ahead towards the rest of 2023 right now.
Yeah, I see that as well. Fundamentally, and from a fund perspective, the funds are much more net short the wheat complex than they are the corn right now. And I think going back to the wheat, yes, the export inspections Monday were disappointing. Yes, Kansas winter wheat conditions are 61% good to excellent, which is much better than last year at this time, and they're 91% planted. But there's also things that we've just kind of stepped over fundamentally, along with the planting progress in states like Michigan and Ohio, and the corn delays in terms of harvest of the corn at this point. Some of these states not even breaking through 30% yet because of some of the delayed wetter, colder harvest weather. That's going to rack up in favor of maybe short covering and tightening of basis if it continues as we get closer to Thanksgiving. The other thing I think needs to be mentioned here, Jesse, is the trade's made a big deal of the South American weather and the improvement in both Argentina and Brazil. I see it. They're pricing it in, but we're a long way away from getting a normal crop in that region. And so I think the weather market in the South American corn and bean belts could be right back on top of the news cycle as we get closer to Thanksgiving if they don't see follow-up rains in the next couple weeks.
Good thoughts, Mike. All right, let's move over to livestock. I want to spend some time with you on the cattle markets here today. Pull up another chart on our video feed, the April live cattle chart. I know with the case of October live cattle, that's off the board now. December's the new front month here. This cattle market has seen its fair share of volatility the last couple of weeks. What's your take? What's your thoughts of where fat cattle are sitting right now as we start the month of November?
I'm still a hedger because of some of the new fundamentals that have come out, Jesse. The idea, first of all, that Thanksgiving is right around the corner now that we're in November. We've got about 3.5% more turkeys than we had last year at this time. If you recall, Thanksgiving was a horrible year for the turkey in 2022 because of HPAI. that has allowed those increase in birds have allowed for about a 22% slide in the price of the turkey that most American consumers buy. We're down from $1.63 down to about $1.27 as of the end of August. And so we're looking at a good 20+% price decline. I think your per capita consumption of turkeys is going to really be pushed hard this year, especially with negative packer margins and a tightening of cattle supplies. So I think there's a headwind there. I think the other thing that goes back to the cattle market is the Chinese pork headwinds. They've gotten worse, not better. And I think that's where, as a hedger, I'd love to be able to get that D's fat cattle market back up to that gap shown on this chart and or the April, I should say, and have the D's lead us there. And if we can get back up into that 190 level, take advantage of that and get into a hedge, a bought put or something like that if we can afford it.
I know in the case of the feeder cattle market, that's kind of become a follower here. It feels like to me at this point, waiting to see what fat cattle are going to do, what cash activity is going to look like. So talk to me about that a little bit. Do you feel that's the case, that feeders have kind of become a follower here? And I will switch charts too, and we'll take a look at the feeder corn ratio. I think this could maybe help explain some of this as well. So kind of a two-part answer here, Mike, or two-part question, I should say. Do you think feeders have become a follower? And then what do you see with the feeder corn ratio right now?
Yeah, I do think feeders have been a follower. I think you pick up on something very important. You know, we made the big break in the feeder market, which we needed from a standpoint of the funds and also the fundamentals. And so now we've corrected those feeders. The feeder fat spread is in the mid-lower 50s again on lead month futures, and that's a good number, not a terrifically high premium in the feeders anymore. Cash markets are also within $1 of where those November feeders are now that they are lead month futures. And so I think feeders are very well positioned to hold some premium unless the funds decide to turn. And I think this is where, if I'm going to be pressed into feeder hedges any further than I've already done in terms of the November and a little bit into the January contract at this point, it's going to be if this feeder corn ratio breaks below the trend line. That would initiate, I think, a fresh wave of selling, of spread unwinding, selling feeders and buying corn. And I think that's where the cattleman, the rancher, really has to watch the corn price. And as we talked about earlier, the wheat price. I think once we make a wheat low, we'll make a corn low really quickly after that, now that we're over 70% harvested in U.S. corn, and we do have that South American weather to keep watch of. So feeder cattle, I'm going to attach more to the corn market. Fat cattle, I'll attach more to the equities and the hog market. And I'll just say one other thing about the consumption side of the equation, Jesse. I'm going to keep track of this very closely, but both Yum, China, KFC, Pizza Hut, Yum came out with earnings. McDonald's came out with earnings. Both of them beat estimates, but they both had softening consumer demand. And in the case of McDonald's, had lower dining traffic. And so this pressure on these higher prices is starting to erode organic volume sales. And I think the packer is going to realize that, and he's going to drill that down into the producer price. And so we got to watch those ground beef prices and watch the packer activity.
Great thoughts. Hogs as well. I want to ask you about the hog market real quick. You know, I thought maybe we're starting to find some support, and then you came in on Wednesday and saw some losses in the hog market, but maybe that was just a case of new month and the money flowed out of the hog trade. What's your thoughts in lean hogs? Are we trying to find a new bottom here and find some footing and support?
I think we are from a standpoint of China, but I'm very nervous. This is very thin ice. The copper markets tried to find a bottom on China, but Monday, you hit it on the nose. Monday, we got fresh China data in terms of purchasing managers index for manufacturing and services. The manufacturing data was atrocious. It says that China is in a manufacturing recession at this point. And I think between oversupply of pork and negative crush margins, and then what you see about the macro side of the equation, the hog sector is in a real tough spot in China. And I think that's where, unless we get a big disease issue, an outbreak in China, I think the hogs, unfortunately, are going to create more headwinds for the foreseeable future against the cattle market and the livestock market as a whole. And I'll be eager to see what the December hogs and pigs report says, to see if we're finally starting to trim some of the supplies back, and we can look for a daylight of tighter supplies as we get to the middle part of 2024.
Mike, floor is yours. Great thoughts again today. Before we let you go and wrap it up, anything you want to mention or reiterate for folks today?
Yeah, just sticking with the program. Federal Reserve and China are the two doors of opportunity for putting in demand lows, putting in long-term lows in the commodities, and bringing those investors back, because I think that would help us secure a top in the U.S. dollar and start bringing our export market back in terms of the grain. So that's what I'm going to keep watching for here as we close out the calendar year. November, December could be pretty exciting months. So get a trial if you can on the website, and we'll see if you like what we write.
What is that website for folks who want to reach out to you, Mike?
Sure. Globalcomresearch.com. It's globalcom with 2 M's research.com.
Fantastic. As always, Mike Zuzolo, Global Commodity Analytics. Great to talk with you again this week. Have a great rest of your week and weekend, and we'll catch up with you next Wednesday. Thanks so much.
Thanks, Jesse. Appreciate you having me.
And that's going to do it for Market Talk today. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.